Ray Dalio is said to be one of the best macro investors alive today. And over the years, he has been preaching that investors should have some exposure to the Chinese economy through Chinese investments. Recently, Ray Dalio was interviewed on his thoughts regarding the Evergrande situation, as well as the recent Chinese regulation going on, given that he has publicly been one of China's largest supporters. In today's video, I want to go through this interview and break down some of the key highlights Ray discusses, as I think they are very important. So with that said, let's hear what Ray Dalio has to say. And this video starts off with Ray being asked about the Evergrande situation.
How can our listeners and our viewers prosper from their micromanagement of the real estate debt collapse we're beginning to see in China? What is the opportunity if we see their dominant investor position domestically go down in price? How do you play that?
Well, the mechanics are the same as the United States went through and everybody else went through. So it would be very similar to our 2008 mechanics.
Or recollapses or whatever.
So what we do, it's happened over and over again, is the central bank makes a decision of moral hazard. You know, they never used to have moral hazard.
Do you believe they're there right now after this week that we've seen in the markets?
Oh, they knew that this was happening, and there's a preparation for this, and they know that there's more, and that's a good thing, not a bad thing, because in the past it used to be that they would guarantee it. The banks, 5 major banks would loan to state-owned enterprises and local governments with implied government guarantees, and it was bad. So the process is the same. Expect the exact same type of process as we would go through, which is to say that there will be stung. Investors will be stung. That's how it works. And that the system will be protected because it's denominated in their own currency.
Beautiful. I want to get this on the record, though, Ray Dalio, because every Wall Street firm is saying this morning this is not a Lehman moment. What we witnessed yesterday in the lesson in price. Explain why this is not a Lehman moment to Ray Dalio.
Well, because a Lehman moment produced pervasive structural damage through the system that wasn't rectified until the Treasury came across in terms of its borrowing, and then the Fed came across with quantitative easing. But this is not that kind of a shake-up type of thing. This is $300 billion is what they owe, and this is all manageable. The basic economics is, for all countries, in all time, is that if your debt is in your own currency, you can deal with it.
You can work it out.
You could work it out. We've seen it happen over and over again. And it's a good thing that lenders get stung or that the borrowers get stung. That's how the system works.
Alright, the first point that Ray makes is that the mechanics in China are the same as over in the US and everywhere else. What Ray means here is that the US and Chinese economies run on the same underlying mechanics of how they deal with avoiding a crisis. He believes that China will print some money to deal with the situation, just like how in 2008, the Federal Reserve had to begin printing money to deal with the financial crisis. This means that the Chinese government will most likely end up taking on at least some of the debt Evergrande may not be able to pay, to avoid a further shock to the system. Ray also says that many countries throughout history have gone through what China is currently going through, and this isn't anything new. It's actually called the debt cycle, and this is when a country gets to a point where it's accumulated too much debt and it now needs to deleverage. So what's going to happen is China is going to have to make a decision of moral hazard, which basically means they're going to have to decide how they handle the situation and what signal it sends out to other companies with taking on debt and managing risk. Like, if China full-on bails out Evergrande and allows them to carry on with business as usual, then it will signal to every other major corporation that they can just take on massive debts and all will be forgiven, and they can just continue over-leveraging themselves. China also knew that this was coming, and Ray believes they were not caught off guard by the whole Evergrande situation, and that they have actually been preparing for it. He also says that all of this is actually a good thing. And think about it. The financial crisis in 2008 caught a lot of people off guard, but right now everyone is talking about Evergrande. A member in my Discord community was actually posting about Evergrande at the beginning of September, so this is something that the Chinese government has most likely been aware of for quite some time. The question is, how will the Chinese government decide to handle the situation, and what message do they want to send to investors and the market by doing so? Ray then goes on to say that ultimately he does believe the Chinese government will step in and handle the situation, but in a way where investors and the company will be burned. Someone has to be burned, or else the signal will be that there is no risk in over-leveraging. And again, he believes this is a good thing, because it will signal to investors that over-leveraging leads to losses. The Chinese system as a whole should be protected though, because most of the debts that Evergrande carries are in their own currency, which makes it much more manageable and easier for China to deal with. I found an article that says, estimates of how much of the company's debt is owned by foreign investors range between $14 billion and $19 billion US. So this is how much of Evergrande's debt is at risk around the globe with offshore investors. And in the grand scheme of things, I don't think that this is that much. On top of this, Evergrande's total debt converts into about $300 billion US, which works out to about 3% of China's total money supply. This means that if China wanted to take care of all of Evergrande's debts, they would have to increase their money supply by only about 3% to do it. Now, on the contrary, the US has nearly doubled its money supply over the past year alone. So China needing to increase their own money supply a little bit to deal with Evergrande, I think should be okay. I also think it could cause some sort of short-term disruption, but in the grand scheme of things, I do agree with Ray that this should be manageable. No one knows exactly how China will manage the Evergrande debts though, but I do believe that China will do whatever it needs to ensure that their country continues prospering in the future. But now, let's continue on and hear what else Ray has to say about China and all of the regulations that they have been doing across their economy in the past year.
Ray Dalio with us at the Greenwich Economic Forum on Bloomberg Radio and Bloomberg Television this morning. Let's go to China now. It's so much in the news. I wanted to wait, but I think we've just got to get to China right now. This is a new Beijing. Is it a return to an old Beijing that you and I knew when you were buying Northeast Air? Or do you envision a Beijing that's moving to a new territory?
Well, you have daughter and son-in-law in Shanghai, and so we get
We're living it in real time.
We're living in real time, and the more you have contact, I think the more you understand it. I don't think it's well understood. For a long time, the question is, how can communism and capitalism coexist? That's the riddle you have to answer, and you had to answer it a while ago. And what do these people want at the top? And what the answer to that riddle was told also by Deng Xiaoping when he was asked. He said, it's glorious to be rich. And then they asked about capitalism, and he says, it doesn't matter if it's a black cat or a white cat, just as long as it catches mice. And so the idea is producing wealth. And so
but it's
capitalism,
changed.
but capitalism, yes, but the redistribution. Okay, so we have four things that are really going on in China, if you understand their intent. Common prosperity is the word now, okay? And it has been the objective to raise money and then to broaden the base of that. Okay, right. That's common prosperity. So if you look at their tax rates, they're lower than the United States. If you look at the measures of almost capitalism, they have as much capitalism or more capitalism, much more so than Europe, for example. And now they're in a prospect to broaden that. So I think there's a tendency, and an understandable tendency, to think because they are Maoist and capital and communist that they're going to go back to that kind of a thing. And they're not. Deng Xiaoping, Xi Jinping, just, for example, introduced the newest stock market in Beijing. He made a point of being the one who introduced the market in Beijing to the small and medium-sized enterprises. They know that it catches mice. And so the issue is that the capitalist is not in control. The issue is that there's a system for the whole system, and then what they want to do is make sure that it's not a capitalist-driven system.
All right, so Ray starts off this clip by saying China isn't well understood, and people should be asking themselves, what do the people at the top want? He makes it pretty clear that he believes the leaders of China want their country to continue prospering and producing wealth, which he also refers to them catching mice. The saying is actually, it doesn't matter if the cat is black or white, so long as it catches mice, which again simply means producing wealth. Charlie Munger also quotes this saying when he talks about China, and it sounds like both Ray and Charlie believe that China wants to continue producing wealth and catching more mice. At the end of the day though, China's goal is to continue producing wealth throughout their economy, and Ray believes investors are mistaking the recent regulations in China as an attack on wealth creation, when it isn't. It's just a much different strategy than we have over here in the Western world. China's strategy is more about common prosperity and redistributing the wealth achieved by the successful businesses throughout the entire economy. China wants to build wealth from the top down and not the bottom up. And how they're doing this is by taking money from the top and redistributing it among the bottom to strengthen their base. In China, there has been a massive economic boom over the past 20 years. Their economy has grown by 9 times in the past 20 years, which is the fastest growth of any major economy history has ever seen. However, despite all of this economic growth, China still has only 41% of its population considered to be in the middle class. This is way up from the 0% in 1995, but it's still a small portion of the population. The middle class is what drives the economy, and China is trying to redistribute the massive wealth the country has achieved to continue growing its middle class base. This explains why Alibaba has been warning investors that they should expect increased taxes. They also said they're now seeing an effective tax rate of about 20%, which is up from the 8% the company saw last year. Alibaba is also warning that most internet companies will no longer enjoy a 10% tax rate, and investors should expect higher taxes on Chinese tech companies from now on going forward. Now, the next key point that Ray Dalio makes is that China is not going back to full-on communism. I think he makes this point because a lot of people are interpreting the recent regulations as China going back on capitalism, and to put it simply, he says they are not. And then he brings up how China is introducing a new stock exchange for small and medium-sized companies, and the Chinese are doing this solely because they know it will continue catching mice, or creating more wealth. The president of China also made the point of being the one to introduce this new stock exchange. In this article explains why they're doing this, so here it says, China will set up a new stock exchange in Beijing to provide financing for innovative smaller companies, President Xi Jinping said, as Beijing tries to increase the role of equity financings in the financial system. China's government has said it wants to raise the share of equity financing in its banks-dominated financial system as part of a campaign to reduce debt levels in its economy, and has recently introduced rules making it harder for companies that manage consumers' data to list overseas. So China wants to increase the banking sector's role in equity financings, which is the banks giving money to smaller companies in exchange for ownership in them. This will allow the smaller companies to sell equity directly to the banks to raise money, rather than having to take on debt. It's a way for China to reduce the debt in their smaller businesses, while at the same time allowing the investors in the financial system to benefit from their growth. It also sounds like China is making it more difficult for companies to list on foreign exchanges like the New York Stock Exchange. This is most likely because going forward, China wants to be the one financing equity deals and benefiting from the growth, not foreign investors. All of this to me sounds like China is trying to strengthen their own economy and promote healthy growth in their own country, and especially in their middle class. Now, I think the reason that investors are so worried about all of this is because the capitalists are not in control. The system and the government is. China has a much different way of doing business than over here in the US and in Western countries. Over here, investors and corporations have massive pull with the government and the decisions that govern them. Western companies can lobby for laws and regulations that are in their own best interests, which we over here have become used to. And investors like this because it means the companies they invest in are less likely to see massive government intervention, which removes an element of risk and uncertainty. However, over in China, the system is in full control. Not the capitalist, not the investor, and not the companies. China will do what it believes is best for the prosperity of the whole nation, not what is best for one company or what's best for the wealthy. China's goal is to create wealth for everyone, and by doing so, it can mean acting against their largest companies' short-term interests, just like how they're increasing Alibaba's taxes right now. So in China, it's a totally different game with a different set of rules and more uncertainty. But now, let's hear more about what Ray Dalio has to say about China and how investors should adjust to everything going on.
I want to go to my number one question to Ray Dalio. I'm fascinated by this. You and I have sat at the M Bar at the Mandarin in Hong Kong and looked at that spectacular experiment. I had the honor of Lord Patton with us the day of the Hong Kong collapse, a change essentially in polity there. How should our Western banks, the people you know, James Dimon, Staley of Barclays, Moynihan of a reinvigorated Bank of America, how should the Western banks adapt and adjust in Hong Kong to new China realities?
Well, I think very simply, you have to decide whether the rules and the place is a place that you're comfortable with. They will set the rules, and you go in there and you decide if you're going to be part of that as a good citizen or you're not. And then, but you don't jump in and out. In other words, China's a strategic play. You're not going to jump in and out. And the amount that you're in should be that which you're comfortable with. It's the same as an investor. It's not smart to sell on the break or buy. It's a strategic play. Most investors are very overweight in the United States or other places. Diversification. There's a competition, a big competition, a war of sorts going on in technology and so on. That diversification, put the amount and the exposure that you want to have there, because you have to have places on some money on two chips, because there are risks in the United States too.
All right, so Ray starts off basically right where we left off, with China having its own set of rules. And he's telling investors that we need to understand these rules and decide if we want to be exposed to them. The rules are, again, that China works in the best interests of the whole nation, and the system sets the rules, not the capitalists. He then goes on to say that you do not want to be jumping in and out of China. And what he means by this is you do not want to become someone who buys and sells Chinese stocks in all of this volatility. You are either in China for the long haul, or you should not get involved in the first place. Now, Ray believes that China is a strategic play and a long-term investment to gain exposure to the multi-decade trend the country and the economy is seeing. The trend is once again simply the sheer growth of the Chinese economy. And as we already learned, China's GDP grew 9x over the past 20 years, and China's GDP is actually projected to overtake the US around 2028. So sometime within the next decade, China is projected to become the largest economy in the world. So investors need to understand that China, again, is a long-term play, and this investment has different rules than US investments. It's basically a totally different game. Ray then goes on to say that investors should only be in China with an amount that they are comfortable with. He is basically telling investors that they shouldn't have too much exposure to China, but he does believe in diversifying some assets into the economy to benefit from China's growth. Everyone has their own risk tolerances and what they want to do with their own portfolios. And again, Ray is just saying stay comfortable with your Chinese exposure and do not overexpose yourself and make China too large of a position in your portfolio. I went ahead and added up all of Ray Dalio's Chinese investments in the Bridgewater portfolio, and as of the second quarter of 2021, the portfolio has about 10% of its holdings in China. These are through diversified ETFs mostly, but his largest single Chinese stock is Alibaba. So from this, I do gather that Ray Dalio is comfortable diversifying about 10% of his portfolio across China to try and capitalize on that multi-decade trend of China's growth. Now, the reason that Ray Dalio is wanting to diversify some of his assets into China is because he also believes that there are risks in the US, just like there are risks over in China. On July 30th, Ray wrote an in-depth piece on LinkedIn that explains his thoughts towards China's moves and why he believes investors should not be panicking. At the very end of this note, he writes, "As for investing, as I see it, the American and Chinese systems and markets both have opportunities and risks and are likely to compete with each other and diversify each other. Hence, they should both be considered as important parts of one's portfolio." So here again, he is saying that there are risks to the American markets, just like there are risks to the Chinese markets, but that he believes investors should still have exposure to both so they can diversify each other. I actually have another video on my channel that I made quite some time ago on Ray Dalio, where he explains everything going on in the US financial system right now. In this video, Ray talks about how he believes the US has gotten themselves in a situation where they will need to continue printing more and more money to avoid a massive economic disaster. As we already saw, the US has increased its money supply by nearly 100% in the past year, and Ray believes that this trend will only continue in the future, and that it will ultimately lead to increased inflation in the US. But to me, it does look like Ray does see risk in the US economy as well, and that risk is simply the loss of the value of the US currency. But that is pretty much going to wrap up the video, everyone, and let me know what you all think down in the comment section below. Do you agree with what Ray Dalio has to say on the whole Evergrande situation and with China in general? Also, for those of you who may not know, I have been working on a brand new project, Stock Unlock. This is dedicated to helping investors learn more about the markets and stock analysis in general. Stock Unlock has the best analysis tools all packed into one nice and easy to use platform. From analyst projections, 20-year historical financial data, analyst price targets, the ability to compare fundamentals of any stock against any other stock, growth rates, historical price ratios, all of it. Now, the reason that I got involved with this project is because I wanted to create one platform that has everything investors need to do a full analysis on stocks, and that's what we are currently building. Stock Unlock is currently in its beta phase though, and it's not yet public, but we do plan on making it public within the next couple of months. If you're interested in Stock Unlock and what we are currently building, then there is an email and waitlist over at stockunlock.com. So if you go and enter in your email, you will be notified with everything we're doing and when we plan on releasing this to the public. Stock Unlock is a huge passion project of mine that I have been working on for months now, and yeah, it would just mean the world to me if you guys wanted to head over there and at least check out what we're doing. But with all that being said, that is going to wrap up the video, everyone. So thank you all so much for watching, and I really hope to see you all again in my next one.